This is ShadowQuant Forex Edition, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Tuesday, June 30, 2026, and this is the New York session. Now, let's get into it. The greenback is rewriting the rules of engagement this Tuesday morning, driving dollar-yen through 162.185 and pushing the fear and greed index down to a stark 14 out of 100. We are seeing a classic flight to safety, but the positioning data suggests the market is dangerously crowded on one side of the trade. As we kick off the U.S. session, the calendar is dominated by a single, critical employment report. On Wednesday, July 1st, the ADP employment report will provide the first glimpse into private sector hiring trends. Then, on Thursday, July 2nd, the non-farm payrolls take center stage. These are the catalysts that will determine whether the current dollar dominance holds or fractures under the weight of economic reality.
And with the ADP report serving as the dress rehearsal for non-farm payrolls, any deviation from consensus will likely trigger immediate repricing in the yen and Swiss franc crosses before the main event even lands.
The broad market picture is defined by dollar strength. The fear and greed index sits at 14, indicating extreme caution, while the VIX has cooled to 18.41, suggesting that this fear is being priced into safe haven flows rather than systemic panic. Gold is consolidating near 3,973.75, and we are seeing a broad rotation out of risk-sensitive currencies into the dollar. Let's dive into the mechanics. We have several key data points moving the needle right now. First, U.S. April case Schiller 20 City House Price Index came in at plus 1.1% year-over-year, beating the plus 0.9% expectation. Second, the FHFA Monthly Home Price Index for April came in at minus 0.1%, revising last month's 0.2% gain downward. Third, Canadian GDP for April came in at plus 0.5%, beating the plus 0.4% forecast. And fourth, Germany's June preliminary CPI came in lower at plus 2.3% versus the plus 2.6% expectation. The case Schiller beat is significant because it reinforces the sticky inflation narrative. When housing data stays hot, the Fed has no incentive to cut, which directly supports the higher for longer rate structure we are seeing priced into the dollar.
But look at the VIX at 18.41. It's calm, too calm. While the inflation data supports the dollar, the low volatility environment means that when the non-farm payrolls data hits, the move could be violent. We aren't seeing a gradual repricing. We are seeing a compressed spring.
That compression is visible in the dollar-CAD structure. Despite the GDP beat, the pair is stalling at the 1.42323 level, failing to break the triple top at 1.4247. The market is telling us that fundamental strength in Canada isn't enough to overcome the technical and dollar-driven resistance.
Let's start with the leader of the pack, dollar-yen. It closed at 162.185, up 0.16%, breaking above the psychological 162 barrier. It is currently trading near the upper end of its 5-day range, which sits between 161.534 and 162.406.
Technically, this is a clean breakout. Price is holding above 162 and the 5-day high of 162.406 is now the immediate test. If we close above that, the path clears for further upside. The structure is bullish, with 161.534 acting as the new support floor.
And that breakout is being fueled by a structural imbalance in positioning. Leveraged funds are holding a net short of 97,092 yen contracts. That is not just a position, it is a loaded gun. The week-over-week change was 98,892, meaning traders are adding to shorts right as the price breaks out. This is a classic short squeeze setup.
I agree with CIPHER on the risk, but I want to challenge Grid's confidence in the 162.406 resistance. Grid, you're treating it as a technical level, But with 97,092 shorts on the table, a break above that isn't just a continuation, it's a forced covering event. The VIX is at 18.41, which is low, but that low volatility masks the fragility of that short position. If price touches 162.406, the squeeze will be mechanical, not just momentum-driven.
I'm not saying it won't be volatile, Spectre. I'm saying the chart confirms the direction. The 162 level was a psychological barrier and it's broken. The technicals are aligning with the flow data.
And let's not ignore the macro driver here. The 10-year to 2-year yield curve is flat at plus 0.28 pp. Typically, a flat curve signals recession fears, but right now, the dollar is strengthening. The market is prioritizing yield carry over growth concerns. The Fed funds rate at 3.63% against a CPI of 4.17% creates a powerful bid for the dollar that overrides the yield curve warning. So we have a technical breakout, extreme short positioning, and a macro environment that favors dollar yields. The risk is clearly on the downside for the yen. Moving to euro-dollar. It is trading at 1.1399, down 0.18%. It is testing the lower end of its 5-day range, which runs from 1.13334 to 1.1434.
The structure here is fragile. Price is within 60 pips of the 5-day low of 1.13334. Buyers are losing traction. If that support breaks, we could see accelerated selling toward the 5-day low. The resistance at 1.1434 is currently out of reach.
The flow data supports the weakness. Leveraged funds are not aggressively buying euro. Meanwhile, the ECB's watch has hinted at another rate hike, but not necessarily in July. That ambiguity is not providing enough support against the dollar's strength. The market is pricing in a wait-and-see approach, which is dragging the pair lower.
It's also worth noting the divergence in inflation. Germany's preliminary CPI came in at plus 2.3%, lower than the plus 2.6% expected. This easing inflation in the largest Eurozone economy reduces the urgency for further ECB tightening. Meanwhile, US CPI is sticky at 4.17%. The spread is widening in favor of the dollar.
The danger here is a false breakdown. If euro-dollar holds 1.13334, we could see a sharp reversal. But given the VIX at 18.41 and the overall risk-off sentiment, I doubt it. The fear score of 14/100 suggests investors are fleeing risk assets, and the euro is the first casualty.
Dollar CAD is at 1.4232, up 0.15%. As mentioned in the news, it is stalling against the triple top at 1.4247.
The triple top at 1.4247 is a critical technical barrier. The 5-day high is 1.42485, so we are essentially hitting a ceiling. A failure to break this level suggests a potential rejection zone. If we see a daily close below 1.4232, it could signal a bearish reversal.
The positioning confirms the resistance. Leveraged funds are net short Canadian dollar at 83,377 contracts, with a weekly change of 18,324. They are betting against the loonie. However, the fact that price is stalling despite this bearish positioning suggests that dollar strength is hitting a wall. The market is saying, I'm strong, but I can't push higher here.
Canada's GDP beat of plus 0.5% vs plus 0.4% expected should have provided more fuel. The fact that it's not breaking through suggests that global risk sentiment is overriding local fundamentals. Investors are not buying the Canadian dollar story right now.
Let's tie this together. Grid identified the technical breakout in dollar-yen above 162, and CIPHER showed us that the 97,092 short position in yen makes that breakout a potential squeeze trigger. Pulse noted that the macro environment, with sticky US inflation and a flat yield curve, supports dollar strength despite recession warnings. SPECTER warned that the low VIX of 18.41 masks the fragility of these positions, suggesting that any break above 162.406 could be violent. Meanwhile, in euro-dollar and dollar CAD, We are seeing technical resistance and fundamental divergence capping upside, confirming that dollar dominance is the primary theme of this session.
To recap, dollar-yen is testing the upper limits of its range with extreme short positioning creating squeeze risk. Euro-dollar is fragile, testing support at 1.13334 as inflation diverges. Dollar-CAD is stalling at a triple top despite Canadian GDP beats. The key takeaway is that dollar strength is broad-based, but the positioning in yen suggests volatility is imminent. Tomorrow, watch the ADP employment report to see if the labor market supports this dollar dominance. This is ShadowQuant Forex edition. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Forex edition. Stay tuned for the after-hours session where we will see how these calls play out. Until then, trade safe.